The S&P 500 just closed at an all-time record high. The ceasefire extension between the US and Iran is the headline fueling this fire, and overnight, the index punched straight into a level that has been a brick wall for months. Here is the problem. The break looks clean, it looks easy, it looks like the start of a melt-up, but I am seeing a liquidity structure right now at 75.65 that has trap written all over it. Most retail traders will blindly chase this breakout and get run over. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am giving out 3 exact entry and exit levels, with stops and targets, that you can use right now to navigate this volatility instant market verdict. The session bias is trending with breakout extension, but we are fading the first impulsive spike if we do not get a confirmed 60-minute close above 75.65. This is a classic by the rumor. Trap the breakout structure on an overextended tape. The trend is undeniably strong. Weekly trend strong buy. Daily trend strong buy. 5-hour trend strong buy. 1-hour trend strong buy. Everything is aligned, and that is exactly why the reversal, if it comes, will be devastating. My invalidation level for the bull case today is 7,503. Write this number down. If we break back below 75.03 on a closing basis, the whole structure shifts from breakout continuation to a failed auction, and we could see a violent liquidation down to 7,485 and then 7,400. The 7,503 level is the floor. That is where institutional passive flows are resting. Lose it, and the bulls lose control. The interaction trigger right now. Drop a comment with the number 7,503 if you are watching this before the US cash open. It tells me you are paying attention and you have your risk levels dialed in. Let us walk through the technical deep dive, because the moving average architecture here is absolutely critical. I am going to narrate the chart from the top timeframes down to the 60-minute. Starting on the weekly chart, we have a vertical staircase. The 20-week moving average is way down at the 7,100 handle. The 60-week is at 68.50, and the 200-week is far below at 61.50. This is a textbook strong bull market. The price is stretched far above all major moving averages, and that tells you the trend momentum is institutional. It is not just a retail short squeeze. The weekly MACD histogram is accelerating higher with no sign of bearish divergence. This is pure trend strength. Now, drop down to the daily chart. The daily trend is also a strong buy. The 20-day moving average is sitting at 74.40, the 60-day at 72.85, and the 200-day average is acting as the ultimate floor at 69.50. The 200-day has been untouched for months. The slope of the 20-day is almost vertical, and that is the kind of momentum that usually precedes a blow-off top or a sustained breakout. The daily MACD is in a strong bullish configuration. The signal line is well above the zero line, and the histogram bars are expanding, confirming that daily momentum is not exhausted. There is no hidden bearish divergence here, which means the path of least resistance remains higher. Now, here is where the edge gets sharp. The 4-hour chart is showing a compression right at the 7,565 level. The 20-period moving average on the 4-hour is at 75.10. The 60-period is at 74.60. Price has been riding the 20-period like a conveyor belt. Every single pullback has been bought aggressively. The 4-hour MACD is still pointing higher, but the histogram bars are starting to flatten. Buyers are not yet exhausted, but they are pausing to reload or get trapped. The 60-minute chart gives us the tactical battlefield. The 20-hour moving average is at 7,548. The 60-hour is at 75.22. Price is currently at 7,563, right above the minor resistance at 75.47 and right at the major resistance at 75.65. This is the inflection point. A 1-hour close above 7,565 opens a vacuum up to 7,600 and then 76.30. A rejection at 75.65 and a break back below 7,547 opens the door to the support zone at 7,503 and then 74.85. The key support levels for today are 75.03 and 74.85. The key resistance levels are 75.47, now slightly breached, and 75.65, the true ceiling. The market is sitting exactly at the line that separates the breakout from the trap. That is what makes today so dangerous and so profitable if you have a plan. Now let us weave in the cross-asset narrative, because this S&P 500 rally is not happening in a vacuum. This is the liquidity tide asset. And right now that tide is being driven by a collapsing US dollar index and the ceasefire shock. The dollar is getting absolutely crushed this morning. As the S&P 500 spikes to record highs, the DXY is breaking below key support, and that negative correlation is working in perfect harmony. When the dollar falls, US equities become more attractive to foreign investors, and the large-cap multinationals get an immediate earnings tailwind. That is the mechanical flow pushing this breakout. But the hidden linkage I am watching most closely is Bitcoin. The S&P 500 and Bitcoin have been in a tight risk-asset correlation, and right now Bitcoin is also rallying, but it is lagging and showing a concerning divergence in funding rates. While the S&P is making a clean new high, Bitcoin is still below its equivalent resistance, and perpetual funding rates are spiking into positive territory. That means late longs are piling into crypto, paying a premium to be bullish, and that kind of sentiment extreme usually precedes a leverage flush. If Bitcoin gets rejected at its own resistance while the S&P 500 finally breaks 75.65, we have a correlation fracture. That divergence is a warning that risk appetite might be peaking in the short term. The ceasefire news also directly connects to crude oil. WTI crude oil is falling on the extended ceasefire, which mechanically reduces the inflation impulse, which gives the Federal Reserve more room to stay dovish, which lowers real yields, which juices equities. This chain reaction is textbook, and it is working perfectly right now. The fear architect, gold, is interestingly not collapsing, which tells you there is still an underlying geopolitical bid, but gold is also not making new highs. It is consolidating, and that consolidation against a rallying S&P 500 tells me that the smart money is not fully convinced this risk-on move is permanent. The 1 to 2 week directional lean is cautiously bullish, but with the trap awareness that a failure at 7,565 could trigger a fast, deep correction. The exact event that would invalidate the bullish thesis is a daily close back below 75.03, or a sudden hawkish repricing of Fed rate expectations triggered by a surprise inflation data point. If we lose 75.03, the breakout narrative dies, and we shift to a range-bound or corrective posture. The second invalidation trigger is a sharp reversal in the dollar index. If the DXY suddenly finds a bid and rips higher, the S&P 500 will get hammered. Watch the dollar like a hawk. Before I give you the 3 trade setups, here is what most traders miss. Most people will skip this section, but this is where money is made. Keep watching. I am going to break down 3 strategies with exact price triggers, exact stop losses, exact target levels, and the risk-reward logic that separates professionals from gamblers. Strategy 1, the sniper. This is the conservative setup. We are looking for confirmation of the breakout, not a blind chase. The trigger condition is a 60-minute candle close above 7,565 with conviction, meaning the body of the candle is at least 15 points and the close is near the high, not a doji. Once we get that close, you wait for the first pullback. The market will almost always retest the breakout level. You enter long on a pullback to the 75.65 to 75.55 zone, but only if the 1-hour 20-period moving average, currently at 75.48, is holding as dynamic support. The exact stop loss goes at 75.35. The logic is that a break below 75.35 negates the breakout, signals a fakeout, and puts the 75.03 floor in play. Your stop is tight, your risk is defined. Target 1 is at 7,600, which gives you a risk-reward ratio of roughly 1 to 2.5. Target 2 is at 76.35. If target 1 is hit, move your stop to break even and let the runner ride. What voids this setup is a break back below 75.65 within the first hour after entry, or a lack of volume confirmation on the breakout candle. If volume is weak, do not take the sniper entry. Wait for a better confirmation. Strategy 2, the active trader. This is the standard setup for those who want to participate in the trend without chasing the breakout. This setup uses the pullback and the moving average bounce. You are looking for a pullback into the 7,503 support zone, which coincides with the top of a previous consolidation and the lower boundary of the hourly demand area. The entry condition is a tag of 7,503 that holds. You do not just blindly set a limit order, you wait for a bullish engulfing candle on the 15-minute chart at that level, or a clear rejection wick with a strong bounce. Entry near 7507 to 7503. Stop loss placement is at 7488. Why 7,488? Because below 7485, the daily structure breaks down, and 7,488 gives a few points of cushion. This stop is logical and placed under a structural low. Target 1 is 7,565, which is the breakout level we are fighting right now. Target 2 is 7,600. The risk-reward on this setup is excellent, approaching 1 to 4 if you manage the trade correctly. Once target 1 is hit at 7,565, immediately move your stop to break-even plus a few points to lock in a risk-free trade. Then trail your stop using the 1-hour 20-period moving average as a trailing stop mechanism for the runner to target 2. This is a high-probability trend continuation play that aligns with the strong buy signals on all timeframes. Let us see how aligned we are as a community. Type your S&P 500 high and low range for tomorrow in the comments right now. I want to see your numbers. Are you expecting a breakout above 7,600, or a rejection back to 7,500? Drop the range. I am reading them, and the best callouts will get a shout-out in tomorrow's video. This interaction also helps you commit to your own bias and prevents emotional trading. Strategy 3, the aggressor. This is the high-risk momentum chase for those who understand how to lose small and manage risk aggressively. The idea is to front-run the breakout on the smaller timeframe extreme. If we are hovering right at 75.63 and the 15-minute chart shows a series of higher lows with increasing volume, and the DXY is actively making new session lows, the aggressor enters long at market, right here at 7,563 with a fraction of normal position size. The stop loss is extremely tight at 75.52. If we lose 75.52, the immediate momentum is dead, and you are out with a small scratch. Target 1 is 7,600. Target 2 is 7,620. The risk-reward is about 1 to 3 if target 1 is achieved. This setup only works if you use a smaller position size than normal, typically half your standard risk unit, and you must accept that the noise in the market can stop you out within minutes. Only for those who know how to lose small and manage risk aggressively. If you are new to trading, ignore strategy 3. Stick with the sniper or the active trader. The warning is explicit. This is a momentum scalp disguised as a breakout entry, and it will stop you out multiple times if the market chops. Risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions held through high-impact news events like ISM data or Fed speakers. Stops are non-negotiable. Execute them mechanically. The market does not care about your opinion, close and retention loop. The one most critical level for the next session is 7,565. That is the number. A decisive break and hold above 7,565 flips the entire liquidity field into a vacuum up to 7,630 and beyond. A rejection and close back below 7,547 activates the bear trap and sends us hunting for 7503. Tomorrow, I will be watching the ISM manufacturing data and any further comments from the US and Iran negotiation channels. That will either pour fuel on this melt-up or slam the brakes. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. The BTC setup is completely different from what the S&P is doing, and there is a massive funding rate trap brewing. Check the end screen and watch that video next. It directly affects your risk assessment here. Smash like if this analysis gave you a clear plan for today. Subscribe and hit the bell for daily institutional level coverage of all 8 key assets. My name is the founder of Alpha Market Meridian, and I will see you in the next one, before the market makes its next explosive move.